So in the last week or so, we've gotten some very interesting stories about the gold market, despite the gold price in US dollars not staying above 1500, although it is not getting smashed way below 1450 or anything like that. So the price action in gold appears to be either going sideways for a little while or correction. But like I said, a lot of smart money people that are not gold bugs are starting to buy the dips. So more people. Yes, a lot of people don't like gold still. Yes, there are a lot of financial professionals that are not buying gold. However, more financial professionals are beginning to look at the global macro data. And by the way, the global macro data, I was just checking my global macro Twitter feed, and the data coming out of South Korea and Japan just keeps getting worse. So for import and export data, it just keeps getting worse. China had bad data recently too in the last week or so. So the global macro data just keeps getting worse, and people are looking at this. People are looking at, if you're managed money professionally, they're looking at what these central banks are doing. So if the pace that the European Central Bank with quantitative easing and the Federal Reserve now with the quote, air quotes here, not QE, where the balance sheet now is up over $205 billion in barely 6 weeks. If this pace continues in 12 months, the total money supply will have increased by $2 trillion. So if you are getting paid to look at all this data, you are scratching your head saying, why is all this money supply being created at the fastest pace since the 2008 financial crisis? By the way, Japan just said, I just saw through my Twitter right before I went on, that Japan is continuing with QE, the Bank of Japan. So if the U.S. is not in a recession yet, and if the U.S. still technically has a global expansion, then why is the U.S. doing preemptive rate cuts? Why has, in just the last 5 or 6 weeks, has 5 months of quantitative tightening, which was balance sheet reduction, why has it all given back? So 5 months of balance sheet reduction has been negated in only 5 or 6 weeks. And that brings us to the gold story. So the gold story was on Monday, October 14th, and it was the Dutch central bank issued a warning: if the entire system collapses, gold will be needed to start over. So the article was published by De Nederlandsche Bank, or the Dutch central bank, and they shocked many with their claim that, quote, if the system collapses, the gold stock can serve as a basis to build it up again. Gold bolsters confidence in the stability of the central bank's balance sheet and creates a sense of security. So the article titled DNB's gold stock states a bar of gold retains its value even in times of crisis. This makes it the opposite of shares, bonds, and other securities, all of which have inherent risk and prices can go down. According to the IMF's latest data, the Dutch National Bank holds 615 tons of gold, mainly in Amsterdam. So they do have some gold. However, they're not a massive central bank. This is not the Federal Reserve coming out and saying this. This is not the European Central Bank coming out and saying this. This is not the People's Bank of China coming out and saying this. So yes, it is good that central bankers are at least discussing this and bringing this public, but this is not one of the major handful. This is not the Bank of Japan coming out and saying this, that they need to go back to gold. So occasionally you may get a central banker here or there. Normally it's retired central bankers that are worried about the system, like Lacey Hunt and Paul Volcker and some of these other retired central bankers that are worried about the system now. But none of the major central banks are doing this. We're on a roller coaster. We're on a very volatile, very crazy roller coaster. We don't know when it ends. We're going up and down a lot. The rules are changing. And this brings me to the only time probably I will agree with Donald Rumsfeld. He said a quote about known knowns, known unknowns, and then unknown unknowns. And this applies best to what the governments, the economies, the treasury departments, and the central bankers are doing behind the scenes. So there's the known knowns when these governments and central banks issue press releases, and then we kind of have an idea what's happening. There's the known unknowns. An example of that would be when we get a partial audit and we find out that the central banks are doing currency swaps, like with the one-time partial audit that Ron Paul got and both political parties actually agreed to, where we found out exactly how much in interest-free loans and currency swaps the Federal Reserve gave out to foreign governments, foreign private banks, foreign central banks, foreign corporations, etc. And that would be a known unknown. So we know that there's currency swaps, but we don't know the exact number. And the Fed wants it that way. They don't want us knowing how much in currency swaps are being given out on a daily, weekly, monthly, annual basis. And then there's the unknown unknowns. So the unknown unknowns are stuff that we don't know anything about unless occasionally a whistleblower comes forth, or occasionally we get a leaked document or something along those lines. So these are things that the people in power are doing secretly behind the scenes, potentially with an emergency meeting. If we ever find out about the emergency meeting, occasionally we'll get a snafu, like with the U.S. Treasury Secretary Steve Mnuchin, where he will botch a press release on Christmas Eve of 2018 and actually mention that the Federal Reserve, U.S. Treasury Department, the FDIC, and the Plunge Protection Team, and all these other alphabet soup regulator groups are all having to meet in an emergency meeting. Or occasionally we get an investigative journalist that actually does a small amount of work, and we find out in May, I think in May of 2019, through a reporter at TheStreet.com, that there was another emergency meeting with these groups over corporate bonds and the junk bond market. Just crazy stuff. So that's what unknown unknowns are the people in power, the economic and political elites, the central bankers, the heads of treasury departments, the leaders of governments of the largest economies meeting behind the scenes. I have to give props to that troll because he actually took a screenshot of my face there and then made a bad profile and then wrote a bunch of stuff. I can't believe he did that. He must have no time on his hands. What a loser. Anyways, back to the show. So it is good that people are talking about gold, but unfortunately, I think, and the quote is with Winston Churchill. And Winston Churchill said, Americans always end up doing the right thing, but normally they do a bunch of bad things in between then. And I think what's going to happen is that the U.S. and the other people who make policy decisions for the global economy, whether it's the Bank of International Settlements and all these others, they're going to try a bunch of different, basically crazy things, including, hopefully I'm wrong about this, MMT, which would make, even here in the United States, which would make even worse stagflation. It would create even more wealth disparity. And so they're going to try a bunch of different crazy things before, and this could be years from now, before eventually gold starts to play a much larger role again in the global financial system. So I think we've already had a bunch of crazy things tried with the central banks. Right now we're on, quote, not QE. QE, I can't even believe I'm saying this. I can't even believe it's gotten this ridiculous at this point. God only knows what they're going to change the name to. I mean, not QE doesn't sound very good. They're going to have to rebrand it. They're going to have to bring in marketing professionals that the Fed's going to pay a lot of money to. They're going to have to do surveys. The Fed has plenty of resources to hire marketing professionals to put a good spin on whatever they're going to call this balance sheet expansion. So in Ben Bernanke's own words, he defined quantitative easing as an increase in reserves balance sheet expansion. So the fact that the Fed is now saying that this is not QE is just ridiculous, because Ben Bernanke was saying only when prior to the first QE program starting that it was. So if you want to read the rest of the article about the Dutch central bank writing about gold, I'll attach a link in the information and description section. The other thing I wanted to do with this gold update, and we're below 1,500, we're at $14.90 and 70 cents right now, and silver is hovering around $17.52. So you would think that at these prices, a lot of the primary gold and primary silver miners would be making good money. And some of them are making pretty good money, especially because oil prices are down. However, these primary gold and primary silver miners, they've only had a couple good quarters now of good margins and good cash flows, and a couple good quarters of good margins and good cash flows does not make up for a bear market that has lasted the last 7 or 8 years. And so I wrote an article for free on Seeking Alpha, and I'll put a link to it in the information and description section if you want to read it. I released it a couple days ago. It's on Seeking Alpha. It's on my blog on Seeking Alpha. And I entitled the article, Gold Prices Around $1,500 an ounce in US dollars, Not Helping Primary Gold Miners as Much as Anticipated. So the summary of the article is there's been no major 100 million plus dollar plus equity financings to help prepare balance sheets of producing miners after the botched $150 million new gold bought deal that was done in August of 2019, and very few new gold mines can be built at current prices because of lack of financing available. And this is the third bullet point for the summary. The largest precious metals, royalty, and streaming companies will benefit from this price correction or sideways movement in the gold price with the best margins, and because they have the best margins, and helping producing copper, gold, and silver miners repair balance sheets. So industry-wide, here's the article, industry-wide gold miners are struggling to maintain current production levels. Same for primary silver miners. Many primary gold miners have delayed for years large capital expenditure or CapEx bills, and many of them can barely afford or cannot afford the CapEx bills. And then here's a good case study. This is why Yamana Gold sold their best producing, best margin, most economic copper and gold mine with, I would add, their longest mine life and most exploration upside, the Chapada mine in Brazil. Yamana Gold did not have a good enough balance sheet to afford the capex bill of approximately $220 million or so to upgrade Chapada, and in the near future, Yamana Gold will also have to sell their 50% stake in Agua Rica because they cannot afford the capex bill on that either. The capex bill was, they're splitting it with Newmont Goldcorp and Glencore, but Yamana's on the hook for about 50%. According to the latest pre-feasibility study, they're on the hook for about 50% of a $2.2 billion capex bill. So it's an economic mine, but Yamana Gold, as of now, unless the feasibility study changes, Yamana Gold would have to pay around $1.1 billion, give or take, in capex, and Yamana Gold does not have the cash or the balance sheet to afford that. So they will have to sell that to a larger gold or copper miner with a better balance sheet who has cash to do that. And Sandstorm Gold has a Goldstream ROFR, right of first refusal. So they have a Goldstream option on it. They can sell that Goldstream option to Franco-Nevada. They can sell it back to the miner and hopefully negotiate a larger royalty. There's a number. They can buy it, the whole thing themselves, or they can split it. It's called syndication between as many other royalty and streaming companies as they want. So there's a number of options for Sandstorm to either sell it, monetize that asset, and make a big profit off of it, because there's a lack of quality gold streams that are that big. If you run the revenues on that number, the revenues right now at $1,500 an ounce gold, according to the pre-feasibility study that came out 4 or 5 months ago, that gold stream, 20% gold stream on 107,000 ounces per year of gold would produce $32 million per year in revenues. So, and whatever the margins are on that, on the revenues. So if it's either a fixed price of gold or 20% or 30% of spot, it's a massive, massive gold stream. And the mine has a 28-year conservative mine life on it right now on the resource, on the reserve. And potentially there's a lot more exploration upside. So it's a massive gold stream. We'll see what happens, but I think Sandstorm Gold shareholders will benefit whatever the management team decides to do with that gold stream. The right of first refusal option on the gold stream. So what this means for Yamana Gold, for the industry is very few new gold mines will be funded. The only exceptions will be very high grade and low cost gold mines like Fruta del Norte, which is currently being built right now by Lundin Gold. The last I saw was on their Denver Gold Forum presentation last month, that the mine is at least 90% done with construction. So that's very high grade. It's in Ecuador. They have a lot of exploration upside. Once there's more operating cash flow at the mine, the mine's producing with operating cash flow, it can be reinvested into more exploration and increasing the size of the reserves. And then also Hot Maden, which is in Turkey. So yes, there's geopolitical risk in Turkey. However, this might be the best gold mine in the last 20 or 30 years. The economics of the gold mine are that good. The grades, near surface, exploration upside, etc. Or smaller gold mines with existing infrastructure already in place to lower construction capex. So this is restarting a mine that may have already been in production years ago, where there's already a lot of the infrastructure. So it's already connected to the power grid. There's already roads leading up. There's a lot of the items there, so they don't have to start building from scratch, because building from scratch on a gold mine, you're looking at hundreds of millions of dollars minimum often. If you are just restarting a gold mine, sometimes you only need 50 million or less. And this is a case with America's Gold and Silver Corporation's Relief Canyon mine in Nevada. Sandstorm Gold also has a royalty and a stream on that, and that mine's under construction too. So that could be online in 6 months or less, generating cash flow for Sandstorm Gold as well, until gold prices stay well above $1,500 an ounce in US dollars. So in my opinion, gold prices would probably have to stay above at least $1,600 an ounce before more than a tiny percentage of new gold mines can get built. Many institutional investors are not believers in this gold rally, at least not yet, although some contrarian smart money investors like Sam Zell, Mark Mobius, and Jim Bianco, who I would not consider gold bugs, have disclosed that they are buying physical gold on dips. So the industry is talking about peak gold, but it doesn't mean we're running out of gold to mine. The miners are running out of gold with all-in sustaining costs below $1,000 an ounce to mine, and with grades industry-wide falling, that means that costs will eventually rise again, even if oil prices stay in a bear market. So this is just the problem with producing a lot of gold or copper or silver or oil, that the more you produce of something or increase production, the harder it is to replace that production with lower cost production. So in theory, the economics textbooks will say, oh, it should be easy to replace production with more production, and the resource companies should become more efficient. The reality of the situation is, for the last 10, 15, 20 years, the exact opposite has happened. Every time grades over a 10, 15, 20 year period drop, the economics get worse. So the costs rise. So even though oil prices are down, they're still moving 2,000 pounds or 1 ton of uneconomic rock to get to lower and lower grade ore. So it's very inefficient. Mining is extremely inefficient, but unfortunately, anything not grown has to be mined. So I don't see mining stopping completely. It would be nice if the global economy, all these corporations could become better at recycling. It would be nice if companies like Apple and others would be better at recycling, but I just don't see it. They should, but they just don't really want to do that right now, unfortunately. So the costs are going to every 7 years, 10 years, and the longer you look out, if you go back and look at the annual reports of these gold mining companies and what the grades were, the grades are going to keep falling unless there's an exception to a rule, maybe a once-in-a-generation discovery, mines like a gold mine like a Fruta del Norte in Ecuador or a Hadmana in Turkey, or for silver, it's the Juanicipio mine in Mexico that Mag Silver owns, 44% of. That mine's not in production. That mine, I think, is not going into production until late 2021 or early 2022. But that's like a once-in-a-generation silver mine. The grades are so good, the exploration upside, the costs are low. Very few new silver mines are anything close to that mine, which is why Fresnillo tried a hostile takeover of Mag Silver a few years ago, like 4 or 5 years ago, and there was a bunch of lawsuits, and Mag Silver had to sue them in court. Fresnillo was playing a lot of games with moving the mine along. They tried to get Mag Silver into financial trouble to buy the asset for cheap, to get them to sell. Okay, so back to the article. The miners are running out of gold with all-in sustaining costs below $1,000 an ounce to mine, and with grades industry-wide falling, that means that costs will eventually rise again, even if oil prices stay in a bear market. Quote, peak gold is a function of price. So it doesn't mean we're running out of gold. It means that we run out of economic gold at certain prices. So 10 years from now, if anyone actually keeps track of this, because most people don't, but 10 years from now, we're going to be talking about probably $1,500 as a new price floor for gold, maybe even higher than that, unless total gold mining production falls off a cliff. So if gold mining production either continues at the same rates we're on or increases, we're going to be talking about much lower grade and much higher cost gold mining. So the higher gold goes in price, the more new mines that could be economic. But those new mines are going to be marginal. Those are not going to be your super high grade, very low cost, long life mines. So the odds of finding mines like that, the longer we go, are going to be decreasing. So occasionally there will be exceptions to that rule, but overall the industry, there is a lack of very high grade, very low cost projects. But even producing gold miners right now cannot raise $100 million or more to fix their balance sheets with equity raises. I have not seen a press release of a gold miner announcing they raised that much since the New Gold bought deal for $150 million went bad in August 2019, and the Canadian investment banks syndicating that deal had to hold onto $50 million of the shares for 2 weeks before they could sell them for break even. And the Canadian investment bankers there was a syndicate. So what happens with these financings is, if there's multiple investment banks doing it, it's called like a syndicate of investment banks doing the bought deal. And they could not sell $50 million of the New Gold shares that they were trying to sell, and they had to hold on to the shares for $50 million. So they had to hold on to $50 million of the shares, and they were, after 2 weeks, able to sell all their shares at break even. So they didn't lose money and they didn't make money. This has spooked all of the Canadian investment banks that were thinking about larger equity financings for other miners. And as I reported from a good source that was at the 2019 Denver Gold Forum last month, these Canadian investment bankers, instead of raising a lot of capital for the miners to stay on their own, what these Canadian investment bankers are doing is working on mergers and acquisition deals. So there's a lot of CEOs at a lot of these mining companies that don't want to run the company anymore because they've been in a bear market too long. Their job has been too hard. They've had to cut too many costs. They've had to fire their friends or employees, or some of them have had to take pay cuts to stay at their job. So they're looking to sell. I would not be surprised to see a lot of mergers and acquisitions in the next 12 to 18 months. The current gold and silver market conditions should benefit cash flowing precious metal, royalty, and streaming companies like Franco-Nevada, Wheaton Precious Metals, Royal Gold, and Sandstorm Gold, and potentially also Maverick Metals, although they're a lot smaller. They only have around 25,000 per year in gold equivalent ounce production. So their revenues are a lot smaller. So for them to do meaningful deals, they probably still have to do equity dilution on every single deal. In the long run, by adding quality long-term deals for more long-term cash flows, if management teams are prudent with not over-leveraging their balance sheets, are careful about counterparty risk on new deals, and do not drastically deviate from the royalty and streaming business model like Osisko Gold Royalty has decided to do. And what Osisko Gold Royalty has decided to do in the last few months is expose shareholders directly to mining risk and maintenance capex bill risks. If the gold mine that Osisko now plans on building by itself does not come in on time and on budget with mine construction and also large surprise maintenance capex bills. So royalty and streaming company shareholders are normally protected from direct exposure to these risks that I just mentioned, as the risks are limited in a number of ways. My educated guess and why shares of Osisko are down so much is that many former shareholders are uncomfortable with the added risks I just outlined. While Osisko does have assets that are pretty undervalued right now, so if you just crunch the numbers about their assets and what the assets are worth, they are undervalued. However, like I've said for a while now, since the announcement of this $300+ million dilution for them to buy the Barkerville gold mines came out, I said like they've added an immense amount more risk. I am personally not comfortable. That's my opinion, not financial advice, with all of the risks that management has added to their growth pipeline in just the last few months. And I personally would like to see Franco-Nevada attempt a hostile takeover with Franco-Nevada offering their own shares and either spin out or sell off the mines that Osisko bought to mid-tier gold miners. So if this gold price correction continues or gold goes sideways for a while, the precious metals, royalty, and streaming companies I already mentioned have the best margins and a portfolio of diversified cash flow assets to use for future growth. Right now, the growth opportunities for royalty and streaming companies are in helping producing copper, gold, and silver miners repair their balance sheets because the Canadian investment banks and institutional investors and hedge funds won't make large capital investments into them besides mining share ETFs. and repair their balance sheets, and taking an immediately cash flowing gold or silver stream of reasonable size without destroying the long-term economics of the mine. The best of these deals yet to come will also focus on future long-term exploration upside. Okay, I got 3 super chats, so thank you, Greg, thank you, Sean, and thank you, Tarkinas. I have not looked at the gold-backed crypto. They're trying to put security measures in. It's weird. I mean, there's been a lot of press releases in the gold community to try to get people on gold-backed cryptos, and I think a lot of them have failed. But they're putting a security device. Some of these firms now, I think the U.S. Mint is doing this too. They're putting a security device on Silver Eagles for 2021. Is it 2021 or 2020? They're putting some type of security device into the metal. Yeah, Andrew Maguire was marketing like some type of gold-backed crypto, and I don't think it worked. I think it failed. Tarkinas asks an excellent question. Does my earlier forecast of 1,600 gold by the end of this year still hold? Yes, I'm sticking to that for now. And I was criticized heavily for saying that I would be happy if silver ended at $18. Remember, silver was above 18 about 6 weeks ago. And I was criticized, oh, you're being too conservative, for saying that you would be happy with silver at $18 by the end of 2019. I'm well aware that the prices are very volatile in these markets. I've been in the gold and silver markets for a decade now. So I knew that when silver went up that high, when it went to 19 temporarily, that there would be a correction. I think things are setting up very well for gold and silver in 2020 and 2021 because the Fed's not QE program is going to expand a lot. So right away, gold and silver are not going to be pricing in this balance sheet increase by the Federal Reserve. But as more and more people see how quickly the Fed's balance sheet is going to start to increase, then people are going to start to get worried about the balance sheet increases. And we could potentially see a scenario where the dollar and gold and silver are both rising together in a increasing crisis scenario. I mean, all these fiat currencies are garbage. All these governments are all doing really dumb things right now. Jim Bianco, I talked about his first tweet where he said there was a discrepancy in repo madness on Thursday. He said that he was running the numbers that with the term repos and the overnight repos that it was over $200 billion in one day. And the New York Fed's website said it was only $104 billion. Zero Hedge also reported $104 billion. Someone was trying to tell me that number that Jim Bianco was quoting was cumulative, but that's not what the chart showed. I reread it. He was tracking on a daily basis. But I didn't talk about his follow-up tweet. So below, there was people commenting below his graph on that tweet. And he said in the second tweet, he said that the Fed is going to have to do many, many hundreds of billions in QE going forward. That it's going to be perpetual. So that is why Jim Bianco, who is not a gold bug, who is a very smart guy, very well respected on Wall Street with his newsletter, Global Macro and Bond newsletter. That is why Jim Bianco is not a gold bug, has publicly disclosed that he is buying gold, even though he just publicly disclosed recently that he had a job interview at the Federal Reserve. And maybe that's why he didn't get the job, because he publicly disclosed that he was buying gold. But he said in his second tweet, and I put a link to that a couple days ago when I talked about this, that he thinks that now going forward, the balance sheet expansion is going to be, it's not going to be, the Fed is claiming right now it's only going to be $60 billion per month for a few months, but he's saying it's going to be like hundreds of billions of dollars very, very quickly. Many, many hundreds of billions very, very quickly. Tarkinas, I don't have any trades set up where if I'm wrong about my market timing call, though, for $1,600 gold by the end of 2019 where I'm going to get hurt financially, so I'm not trading on that. But this is just my opinion, not financial advice. If anyone's trading on that, they have to be careful and have hedges because it's going to be very volatile. So all the physical metal I own and the Sandstorm Gold shares and my speculative position in Alexco and my Wheaton Precious Metal shares, none of those things, it doesn't matter if gold goes to 1,600 by the end of 2019. That's what I'm saying. Because I know that the CEO of Sandstorm Gold is going to keep doing more deals and adding more smart long-term cash flow to the pipeline and keep diversifying his cash flow. And then this takes me to my article, which is behind the paywall on my Patreon. And thank you very much to my over 170 now Patreon account contributors. It will hopefully be over 200 in a couple months. Things are really rolling now. And this takes me to what I wrote. I wrote a 9-page in-depth article updating people about Sandstorm Gold. It's only for people who are subscribed to my Patreon account for $5 a month. I've had multiple hedge fund managers ask for the article for free, even though they're worth a lot of money, and I told them, no, I will not do that. This is only for people who are willing to bet on me, bet on my content, bet on my channel growing, bet that I will get funding for my educational technology company, bet that I can wake more people up. And what the article, one of the main themes of the article is that the CEO doesn't even have to take a lot more risks with the company. The CEO just has to do smart, small and medium-sized deals for immediate cash flow or near-term cash flow, and the market is going to keep re-rating, keep increasing the multiple on the company's cash flows. So the company is going to keep getting a better and better valuation in the years to come because they will have more and more diversified cash flow. And I think there's lots of people that do not understand this. Basically, nearly all the article writers on Seeking Alpha do not understand anything of what I just said. So this is why precious metal, the larger ones, precious metal royalty and this is why the larger precious metal royalty and streaming companies are so good, because if the gold price doesn't go up, if it goes down a little bit or goes sideways, they just do more deals. Whereas the mining companies are struggling still. So the mining companies may have better revenues, may have better cash flow, may have better margins. However, a couple quarters of good increasing revenues with the lower oil prices, better margins, better cash flows, does not make up for a bear market that has lasted for 7 to 8 years. So the royalty and streaming companies, unless they do something extreme, and I would say very risky, like what the Osisko Gold Royalty did, which is drastically deviate from their business model, from the royalty and streaming business model, unless they do something like that, they should benefit from a market condition where the gold price and silver price don't go up, because the miners need capital and they can't raise it. And you'll have to trust me on this because I've interviewed a lot of experts, but just my opinion. But the mining companies, if they're producing mines, if they have multiple producing mines or they're building a new mine, they almost always need more capital. Okay, so the royalty transfers with the land. The royalty transfers with the land. So if this happened with Sandstorm Gold when Primero Mining was in financial trouble and then McEwen Mining bought the asset. Bought the Black Fox mine in Canada. So people were like, oh, Sandstorm Gold's gold stream was in trouble, and then McEwen Mining bought it. So the royalty transfers with the land. So if a miner goes bankrupt and another miner buys the mine and the land, the royalty transfers. And normally streams, if the mining company's in trouble, what happens? Royal Gold restructure a stream. So the streams can get restructured. Wayne says he analyzed the Fed repo data and figured out how Jim Bianco got $205 billion in repos. Hey, Wayne, send me an email. wallstreetformainstreet@gmail.com if you want to talk more about that. He didn't actually say how he got the numbers, because the New York Fed data, it's only $104 billion. I checked it. I don't know how he got the numbers for the overnight and the terms. And the term repo. Yes, 2 trillion. So the projected amount in the next 12 months for just the European Central Bank and the Federal Reserve, if the ECB continues on their QE pace and the Federal Reserve continues on their on their air quotes here, not QE, on the pace that they're on now, because they've increased the balance sheet 205 billion in 6 weeks. So if they continue on that pace, the ECB and the Fed alone will have increased by 2 trillion in just 12 months, which is the very similar amounts to what happened at the height of the 2008 financial crisis. My personal thesis, though, why gold and silver is not doing well, and why cryptocurrency is not doing well, and gold prices in Chinese yuan are not doing well, I think it has to do with the Chinese government, and why the rollout for their government crypto is, according to multiple sources, occurring in the next month. So we'll see. I think China is smashing all of that stuff to try to crack down on flight capital. And they've gotten a rally in the yuan against the dollar. But from what my sources say who are in mainland China, they don't trust the rally. They don't believe the rally. They don't trust it. There's increased sentiment from the sources I speak to in mainland China that want to get more of their savings, more of their capital out, despite the rally in the Chinese yuan against the dollar. Oh, thank you, Steve. I'm glad you liked the show. Oh, thank you, Gabriel. I'm glad you like my show, too. Omicron 1112 asks, how will quantitative easing fail, and will we have an idea when the markets will crash? Well, the global macro data is looking really bad, so a lot of capital has come into the U.S. Will quantitative easing fail? A lot of financial professionals who manage money don't want it to fail, so they're going to go on mainstream financial media and lie. So they're going to try to confuse, obfuscate, and fool as many regular people on Main Street as possible. And your stockbrokers are going to be, if there is a stock market correction or crash, oh, it'll come right back, oh, buy the dip. The people in power at the U.S. Treasury is so reliant now on capital gains tax revenues on stocks, bonds, and real estate, they can't allow a stock market crash to last for more than like 12, I don't even know if they can allow 12 months without doing all kinds of crazy things like rules changes, interventions, propping up companies. Like what they did with the largest publicly traded home builders is the largest publicly traded home builders got bailouts and tax credits so they wouldn't all go bankrupt. The leading economic indicators for the global economy are really, really bad. They've been getting bad since the beginning, end of 2018, early 2019. That's why I was saying at the end of last year that oil prices look bad to me. Thank you for the super chat. I don't have any mining stocks except for speculation in Alexco. I don't like the mining companies because I know how they're run. I have a whole playlist on mining stock education where I talk about a lot of the red flags, and you cannot buy and hold any mining stocks for the long term. The mining stock ETFs give you a basket of them. You can maybe trade for a short-term trade some of these mining stocks, but I would not buy and hold any of the. If you buy like a mining stock and you check back like 5 or 10 years later, the mining company could have really screwed things up, diluted the shares, or tried to bring on a mine that was too big and then gone bankrupt. So there's so many things that can go wrong at a mining company that I'm not personally buying and holding any of these mining companies. I have a speculative position on Alexco that I've disclosed. They're a silver miner that's bringing silver production online in Canada. They already had all the infrastructure at the mine there. They only need a small amount of capital to restart mining 4 million ounces of silver per year. But let's say if silver were to have a big rally, I would not hold those shares. I would probably dump a lot of my shares or sell all of them. So I'm not planning on buying and holding that position for many, many years because I know how bad the mining business is. It's very cyclical. There's always the possibility of a hidden maintenance capital expenditure bill, a large one coming. So mining is not a buy and hold. Mining stocks are not buy and hold. The only buy and hold I personally, with my own money, again, just with my own money, not financial advice, is the royalty and streaming companies. So if you would have, this is analyzing the past, but if you would have bought shares of Franco-Nevada in 2013, even though the gold price went down, went down a lot from 2013 up until the last like 12 months, then you still would have made a lot of money. Let me pull up the share price of Franco-Nevada really quick. So Franco-Nevada is right now at $93 a share, and they've increased their dividend. Their dividend yield's up to 1.07%, but they've had dividend increases every year since 2007 when they re-IPO'd. And Franco-Nevada was, even though gold prices went down from 2013 for a number of years, they still increased their revenues. They did more deals for cash flow. They increased their revenues, and the shares of Franco-Nevada went from like 40 something per share up to 93 now. So the royalty and streaming Franco-Nevada proves that the royalty and streaming business model, if it's run correctly, and once the companies are large enough to have diversified cash flow and then reinvest those cash flows into more growth to add more diversified cash flow. And by the way, those of you who are saying that Franco-Nevada is in danger of their oil investments, supposedly I was just looking at numbers. Franco-Nevada is actually making tons and tons of money off their royalties in the shale patch because of how much drilling is being done, even if it's uneconomic. Because Franco owns royalties on the land, and so the more drilling that occurs, the more cash flow they get. It doesn't matter to them about the profits. So Franco's getting their royalty payments based on how much drilling is getting done and the revenue. So they're benefiting from the shale Ponzi. It's really funny. But they have like 80% of their revenues are in gold and silver. So what Franco-Nevada proves is that the business model, once the companies get to a certain size, I would say Sandstorm Gold size or larger, is that the company can start really making smart growth investments and there's very little bankruptcy risk, unless management over-leverages the balance sheet. So buy and holds to me, if you would have just bought and held Franco-Nevada shares when the gold price was going, if you would have screwed up on timing of the gold price and bought in 2013, you would have, on your shares, you would have more than doubled your money in capital gains, and you would have gotten 6 years of dividend increases on Franco-Nevada shares. So then you wouldn't have had to worry about the gold price. You wouldn't have cared. You would have more than doubled your money and gotten 6 years of dividend increases. That sounds pretty good to me. The average retail investor, unless they're doing extensive research on their own or they're paying for a good paid newsletter, should not buy any individual mining stocks. That's how dangerous mining stocks are. That's how poorly run many of these companies are, in my opinion. The industry is just enormously capital intensive. And like I said in the article that I read to you, the Seeking Alpha, that the industry is capital intensive in any part of the cycle. The industry is capital intensive, whether it's maintenance capex expenditures or capex to build a mine, or capex to repair the balance sheet, or an unforeseen capex expense. There's flooding at the mine, or there needs to be an upgrade at the mine, and Yamana Gold had to sell their best, lowest cost cash flowing asset. So the industry needs capital all the time, and right now very little capital is available. Nick says he agrees that 95% of people shouldn't buy junior mining stocks. Yeah, I agree, Nick. And unfortunately, I get emails all the time from people who watched a YouTube video and fell for a mining stock promoter or an ad. They watched a YouTube video. They said, oh, that company sounds good. They bought a lot of shares. The shares are down. It's sad. I've warned people a lot. If a company's running a lot of ads on YouTube videos, probably not good company unless the company's making money. But how many miners are making money consistently? Hey Sean, thanks for having my back. I'm not anti-oil, I was an oil analyst. There will be a time and a place to buy oil, it's just not right now. Sean, I appreciate you having my back with the troll. The reason I'm not bullish oil, number one, global economy slowing down a lot, so that could reduce demand temporarily. And number two, it's how much of the shale oil is being subsidized. I've tried to point this out for many, many months now. Almost all of the shale oil production is completely and totally uneconomic and subsidized. It's subsidized by the U.S. government, it's subsidized by the banks, and it's subsidized, unfortunately, by the sucker pension funds, over $1 trillion, who got suckered into investing in shale with promises of earnings, free cash flow, and dividends. And a lot of these shale company CEOs, their business model, it was very similar to the Silicon Valley technology unicorns that was revenue growth only. But the problem with oil companies is it's very capital intensive. So every year to maintain or grow production levels, it requires more and more investment or capex into drilling. So the costs are not going down for shale. The costs of capital go up. The amount of capital needed go up. So the cost to drill has gone down. Shale used to cost like $65 or more to drill, and maybe the costs have come down a lot, but the amount of capital needed to drill all these wells and maintain or increase production, and a lot of the sweet spots have already been drilled. So there's so much waste, fraud, corruption, and abuse in the shale oil patch that I don't want any part of it. And then you have CEOs like the ExxonMobil CEO saying that they're going to get double-digit returns in all their shale investments. I don't believe it. I'm calling BS. I don't believe it. Right now, the only part of the industry that's really going to benefit is the refiners. If oil goes lower, stays at these levels, or goes lower, the refiners are going to benefit. Just my opinion. I don't like Metalla. Metalla doesn't have enough cash flow. Every time Metalla has to do a deal, they dilute like crazy. They dilute way too much with shares. I know a lot of people like Metalla, but they have to dilute way too much. Fred says there's not enough gold in the world to peg a currency to it, that there will not be enough in circulation. This will create massive deflation, which is the opposite of what central bankers want. Hey, Fred, that's totally inaccurate. There is plenty of gold. It's a question of price. And the people in power right now do not want to give any respect or credibility to gold, and that would mean a radically higher gold price. Probably not the $87,000 Bill Holter is claiming, probably closer to like $10,000 or something. Okay, there's plenty of gold. The people in power just do not want to raise the gold price, raise the silver price. They don't want to give any respect to that. They're going to try a bunch of other crazy things for however long this lasts, for the next couple years, however long everything lasts until the next crash or collapse or system reset or whatever they end up calling it. Okay? And the other, let me give you a historical example. So Winston Churchill, mistakenly after World War I, when they reset the gold price, they should have raised the gold price a lot they should have raised the gold price a lot higher, and they refused. So the people in power, the governments, the central bankers then, they refused to raise the gold price then. They set the gold standard back then after World War I, because during World War I, I believe the countries temporarily went off the gold standard so they can print money for the war. And then they went back on a gold standard, and they set the prices at the pre-World War I gold price. And they set it so low that all the money and credit supply in the global economy was too low, and that's what caused the deflation. So no, there is plenty of gold. It's a function of price. The people in power just don't want to give gold the respect. And eventually what happened is you go back not only to what Winston Churchill did, and then the gold price was set too low, and then that caused, along with the Federal Reserve with the Roaring Twenties putting way too much money and credit in. There was a lot of QE back then and misallocation of capital. Murray Rothbard talks about this in his book, America's Great Depression. There was tons of credit binges going in the 1920s. The Roaring Twenties were tons of extra credit, and the gold price was set too low after World War I, and that's what caused a lot of the problems. The other example is FDR, what FDR did in 1934. So FDR and his economic advisors, all the crazy Keynesians, tried a bunch of crazy stuff. You know, they tried to even put people in jail for wage and price. They had so many crazy wage and price controls during the Great Depression that they tried putting people, small business owners, in jail who were lowering prices below. There was dry cleaners, there was butchers, there was chicken guys. There was a Supreme Court case about this. It was nuts. Anyone who tried lowering their price, FDR tried throwing them in jail. And then when the Supreme Court case went against FDR, he tried stacking the Supreme Court because he didn't get what he wanted. Yeah, there's almost 400 people watching. YouTube's still going to say that this video didn't even get 1,000 views and hardly any likes, and they're still removing my ad revenue very quickly. I think it's down 30% in the last month. And I've added less than 100 new subscribers in the last 6 weeks. Koisi says, imagine going to jail for selling apples at half off. Oh, what actually the growers did for apples and oranges is they were actually paid to grow the fruit and let it die. The problem with Steam or DTube, I have friends who have over 100,000 YouTube channel subscribers go there, and none of their audience followed them over, and they lost all their ad revenue and all their audience going there. Wayne? Yes, that's my email. So FDR and his Keynesian, neo-Keynesian or Keynesian cronies, they tried a bunch of really crazy stuff. You really have to read the books from Amity Shley's The Forgotten Man about the Great Depression and Murray Rothbard's America's Great Depression to hear all the crazy things FDR tried. And after FDR tried all these crazy things, and FDR basically doubled down on a lot of the stuff that Herbert Hoover did, and Herbert Hoover is incorrectly labeled as a free market guy in generalist history books in college. I know I was taught that, and I know it's a lie. And then after FDR tried a bunch of really crazy things for years, finally then he devalued the dollar against gold and raised the gold price. But then, of course, the Americans weren't allowed to keep the gold with the higher gold price, and so he tried confiscating it, and then I think there was a $10,000 fine and jail time if you didn't hand in your gold. But I think a lot of Americans got around that by, I think they moved their gold up to safety deposit boxes in Canada. Oh, great bearded one. So it says the Supreme Court used a case against the guy to strengthen interstate commerce laws because he sold bread too cheap. He grew his own wheat, made it into bread, and it was too cheap compared to out of state. Yeah, that sounds about right. And FDR lost some of those cases. He tried throwing these small business owners who owned a butcher shop. They were selling low, like deals on chicken, on roasted chicken, and I think he tried. They tried lowering their prices below the price controls, and they tried to throw them all in prison. And it went up to the Supreme Court, and FDR lost the case. And then he went nuts, and he tried to rig the Supreme Court. The history books are way too kind to FDR. He is worshipped as a demigod. Okay, I'm going to look through listener questions and comments one more time, and then that's it. My voice is starting to go. Franco-Nevada has outperformed, shares of Franco-Nevada have outperformed Berkshire Hathaway in the last 10 years, just like gold has outperformed shares of Berkshire Hathaway in the last 20 years. So not a lot of people are aware of that. So Warren Buffett can say, oh, he hates gold, oh, it's useless. By the way, most people don't report on this. Warren Buffett was the one who had stockpiled 100 million ounces of physical silver. And then from what I've heard, there's different versions of the story. He was accumulating it starting in the late 90s, I believe. And he was told by the U.S. government he was accumulating it in London on the LBMA. And the U.S. government found out, the U.S. Treasury, and they told him he had to sell the silver. And that's how the SLV was created. So Buffett can talk shit on gold, but he was stockpiling silver. And then he was ordered out of the market. Farmers and miners are the only two groups that make new wealth. I disagree. If you create a new product or service, you've created new wealth. If you're doing research and development and you innovate and you create a new product or service, that's new wealth. Now, the problem we've gotten into, great bearded one, is these Silicon Valley unicorn business models, where it's revenue growth only, and then you have SoftBank committing fraud. The stuff they do where they raise a tiny amount of new capital at a higher valuation, and they say, oh, all our other shares are valued at this higher valuation. So it's a fraud. Legitimate new products and services, profitable businesses, that is creating wealth. So yes, miners, oil, farmers, but also the most valuable things people can create are with their own mind, new products and services. Which is why we need more entrepreneurship in this country, in the United States, not less. And not the BS business model that the Silicon Valley unicorns have, where it's revenue growth only. That's the problem. Or the shale oil, the shale madness. I don't know if we're going to see a 8-to-1 gold to silver ratio. Let's talk after it goes down a lot. Let's talk after it's closer to 50 or 40 to 1 first. No, not really. Not with an internet business. You don't have to do it with the minerals. There's plenty of new products and services to come up with. You're welcome, Rob. I'm glad you liked it. Okay, so we're almost at an hour. My voice is going. I want to thank everyone for listening, and thank you very much to my over 170 Patreon account contributors, my dozen or so monthly PayPal contributors, and people throw me a tip once in a while. You can donate on crypto if you want. There's a crypto donation link, so thank you very much. No, I'm not a crypto pumper like Bill Holter is saying, and I told you why earlier in the show why I think crypto prices are going down so much, along with the gold price, along with the gold price in Chinese yuan. So that's enough for right now, and I'm going to focus on more content for the rest of the week.